I'm going to turn it over to Gary, and he's going to start his presentation.
Good afternoon, everyone. Thank you, Bill. My name is Gary Surfaus, and I'm a CPA forester. My office is located in Winter, Wisconsin, which is in the northwestern part of the state in Sawyer County. A little bit on my background. If I can get it to move to the next screen. There we go. Okay. Thank you. As I mentioned, I am a certified public accountant, also an enrolled agent, and a certified forester. I was a forester first. I got my BS in forestry from the University of Wisconsin-Stevens Point, and working with a sawmill. And when I bought timber from private landowners, they would always ask me about the tax aspects of it, and I told them that they needed to go talk to their tax advisor, which they would do, and then they'd come back and say that their tax advisor didn't know anything about it. So that's how I got interested in this field and went back to school at the University of Minnesota. I've been doing tax returns now for over 20 years, getting close to 25 years. Member of American Institute of Certified Public Accountants, Wisconsin Institute of CPAs, Society of American Foresters, National Association of Tax Professionals. That is my picture there on the left side. I am the owner and operator of 2 tree farms, one that's been certified since 1982, and I do live on my other tree farm, which is a picture right there. That's part of it, obviously. It doesn't look quite like that today. It's pretty much all covered with snow and ice right now. I've been involved with webinars prior, but always on the receiving end. I've never done a presentation this way. And one of the things that does concern me as a presenter is that I cannot see what you're thinking, etc. when I'm talking. You know, generally, if I'm talking in front of a group and your eyes glaze over, I know that I've lost you, or you get a questioning look on your face, etc. So what I'd like to ask you to do is to use that question feature that Bill pointed out earlier. If you're confused but don't know your question, just type in a question mark and send that in. If Bill starts getting a flood of question marks, then I know that I'm going too fast or I've lost you. Okay, so I'd appreciate that. So let's get started here. You've acquired a piece of forest property. Okay, now what are we going to do? And this is basically what we're going to talk about here today. Is it a hobby, investment, or business? And if it is a business, how should you organize that business? What expenses are you allowed to deduct? If you're selling timber, how is that? How are those timber sale proceeds going to be taxed? Is there anything that you can deduct against those timber sale proceeds? And finally, you're planting some trees. What can you do with those expenses? So let's first start with the hobby, investment, or business. Those are the 3 categories that in essence, you have to pigeonhole your business or your investment, your hobby into one of these 3 categories. Depending on which one you decide on, is going to have a big impact on how you treat the income expenses from that activity. Now, we just can't pick one. Okay, there are some criteria, and what separates hobby on one side from investment or business on the other side is the presence or absence of what we call a profit motive. Okay, over the lifetime of this activity, are you going to be generating more in revenues than what you're spending in expenses? And if the answer there is yes, then you could be classified as either an investment or as a trade or business. If the answer there is no, then your tree farming activity would be classified as a hobby. So what difference does it make? Okay, if you're treating it as a hobby, okay, generally you are only allowed to deduct expenses up to the amount of hobby income on a year-by-year basis. So if you didn't have any income, say in 2008, then you wouldn't be able to deduct any expenses, other than, one exception, your real estate taxes. Okay, you would show your real estate taxes on Schedule A up here in the taxes section right in here. Okay, you would show your real estate taxes. Your other expenses up to, let's say if you had some hobby income and you have hobby income that exceeds your real estate taxes, you could take other hobby expenses up to that difference there between the hobby income and the real estate taxes as a hobby expense, and they would go down in this miscellaneous itemized category here. One problem here is that in the miscellaneous category is that all of your deductions in that area are totaled up, and then they're compared with 2% of your adjusted gross income. And you're only allowed to deduct expenses that exceed that 2% of adjusted gross income. So if you have a lot of expenses in that miscellaneous category, you can sometimes lose those due to that floor. If you're treating it as an investment, you are allowed to deduct expenses in excess of income on a year-by-year basis. And so even if you didn't have any income in 2008, you could still take expenses, though you need to treat those expenses as itemized deductions. Again, your real estate taxes, you would show up here in the taxes section. You may have some interest on the property, which we would call then investment interest, and that would go down here in the interest section. That is subject, there are some investment interest limitations. You're only allowed to deduct up to the amount of investment income that you had during the year, though if there's any excess, it would carry forward from year to year. And then your other investment expenses would be down here again in the miscellaneous itemized category, subject to that 2% floor. If you do have a significant number of expenses in that miscellaneous category, you can make the election, and also if you don't itemize, okay, you can make the election possibly to capitalize some of those expenses, assuming that the property is unimproved and that you had no income from that property during the year. So that's always available. If we're treating it as a business activity, then the income and expenses will go on some kind of a business schedule. Okay, that could be a Schedule C or a Schedule F farm schedule if you're self-employed, or if you're set up as a partnership, that would be on a Form 1065, or if you're a corporation, it would be either a Form 1120 if you were a C corporation, or 1120S if you were an S corporation. And all your expenses then, if you're treating it as a business activity, would be deductible against all other income. And so on this particular slide, we've got a loss there of $3,375. That will flow through to the front page of this person's 1040 and will then reduce his other income. So from a tax standpoint, treating as a business is the best. But the problem we have here is that we do have to be able to prove that profit motive. And the problem we have with timber properties is that over time, especially if your tree farm is small, you may not be generating a lot of revenue. So you may, like this particular landowner, have zero revenue and then have significant expenses year after year after year. And that tends to raise your audit score. And so you might get some kind of a letter from the Internal Revenue Service saying that, hey, we think that this activity isn't a business, it's a hobby. And so you need to then basically prove that you are actually in this to make a profit. Okay, now that doesn't mean that, if you decide that you're going to be a hobby, okay, you don't have to pay attention to this because the IRS isn't going to bother you about that. But if you do choose to treat it as an investment or as a business, then you need to pay attention here. They do have that 3 out of 5 year rule. It's kind of a rule of thumb that if you do have a profit in 3 years out of the 5 and the losses in the remaining 2 aren't way out of line, then they won't bother you. But if you don't meet that criteria, these are some of the ways you can prove then that you do have a profit motive. Number 1, that you conduct the activity in a business-like manner. Okay, that means that you have some kind of an accounting system set up. Maybe you have a separate checking account for your tree farming business, that type of thing. They also look at having some kind of a business plan. And many of you may have the start of a business plan. It's probably called your forest management plan. The only problem with your forest management plan It does tell you what you're going to do and when you're going to do it, but it doesn't have any numbers attached to it. And so you may want to take some time to say, okay, well, here I'm going to have a harvest in this year. This is what I anticipate to harvest, and this is what I anticipate then receiving from that harvest. Or I'm going to be doing this timber stand improvement activity in this particular year. This is what I anticipate it's going to cost. And then also add in your annual expenses, like your real estate taxes, equipment depreciation, that type of thing. And so when you total up the numbers, then that's pretty much going to be your business plan. Also, take a look at the top of that management plan. You've got an objective statement there. What does that objective statement say? If it talks about aesthetics, talks about improving habitat for wildlife, grouse and deer in particular, because that's what you like to hunt, you could have a little bit of a problem there because that would be personal use, and the IRS is looking for profit activity. And so you want to have something in there that would, in essence, say that your objective is to produce commercial timber products at a profit. Not that the IRS is against the aesthetics or the wildlife or that type of thing, but from a tax standpoint, they're looking for that profit motive. And the objective statement, if the profit motive isn't in there, you're going to have a hard time then passing that audit. So that's one way we can prove it. Another is that you either possess, which you're learning. You're here today, so you're learning different things about, and you've been through here the whole series. You're learning different things about how to manage your property, or you hire advisors like a consulting forester who possess the experience to be able to operate this business profitably. Number 3, you personally spend the time and effort that suggests that you do have that intent to earn a profit. Number 4, if this is your only business activity and this is what you rely on for putting bread on the table, it's much easier to prove that it is a business activity. If you have substantial other sources of income, say like a 6-figure job or a large pension coming in, that type of thing, then you obviously wouldn't be able to rely on number 4 here. And now you don't have to meet all of these. Okay, they're just looking at a preponderance of evidence here, and so you don't have to meet all these. Success you've had in similar activities in the past. Have you been self-employed in the past? Have you had a business in the past? And how did that turn out? Do you have significant profits in some years? And that's one of the things you may be able to prove with your business plan, that you will have some significant profits if you haven't already when you have a timber sale. And finally, then number 7, well, not finally, I guess there's one more after 7, the expectation that the assets may appreciate in value. And this is an important one. If you're out there and you're doing some timber stand improvement work, you've got a expense item there, but what's happening is that you are improving the timber. So what you're left with is your larger timber, your better quality timber, and it's going to be growing at a faster rate. So over the time that you're holding this property and managing this property, those trees are going to be moving from, say, the pulpwood class to the small sawlog class to the sawlog class, and perhaps some veneer. They're going to be appreciating in value, and you can include that appreciation in your analysis to prove that you are holding this property and this business, this investment, and you do have that profit motive. And then finally, this is a tough one for us to meet. The activity lacks elements of personal pleasure or recreation. Like I said, pretty difficult for us tree farmers to say that we don't get much personal pleasure or recreation out of owning our tree farm. And it's kind of interesting to look at the court cases when they're looking at this particular point. Some judges will say, well, it's just the fact that you have a tree farm, that you're not going to meet this criteria. Others say that, well, you don't have to hate your job in order to have a profit motive. So that's kind of interesting. The most important ones, I think, out of the 8 is going to be the first one, conducting the activity in a business-like manner, having your separate accounting records, the separate checkbook, having your business plan, and number 7, the expectation that the assets may appreciate in value. So those are going to be the 2 more important ones. If you can meet those and 1 or 2 of the other ones, I think you should be in pretty good shape. So let's say that you've determined that you are operating the activity as a for-profit. So then what are you? Are you an investment or are you a business? And unfortunately, this term is used over and over in the code, but it's not defined really any place. And any definitions that we do have are not consistent. And so our accepted definition, a business would be a regular and continuous activity, so something that's ongoing all the time, whereas an investment doesn't have that regular and continuous component. So that doesn't help you a heck of a lot, does it? There was a person who gave me a call last tax season, and they were audited on this particular issue, and the IRS really didn't give them any guidance as well. But I think what the IRS is trying to do is to get it into court so they can get a little bit better definition of between what is a trade or business and what is an investment. But right now, this is basically all that we have as far as a definition there. So in the past, if you've met the profit criteria, we basically said, well, whatever you choose, either trade or business or an investment, but you may want to think about that a little bit now in light of the fact that the IRS is starting to look at that and say, well, am I really out there doing a lot of the activities enough to call it a business activity rather than an investment? If you do decide to go the business route, there are different forms of organization that business can take. You can be just a simple sole proprietor, which very simple to set up, very simple to close out. If you decide to do that, you would file on a Schedule C or a Schedule F. Or you could get as complicated as a C corporation or an S corporation on the other side there. Basically, what differentiates the business entities on the left side versus the ones on the right side is the limited liability provisions. When you're a sole proprietor, you're basically responsible for everything that happens on that property or in regard to your business. And all of your assets are at risk, not just the business assets, but your personal assets as well. Whereas on, say, a C corporation, S corporation, or a limited liability company, basically the liability is limited to the business activity and the assets held by that business activity. Okay, now that's not absolute. There are ways they can pierce that corporate veil, and so I wouldn't rely on that and then not go out and buy liability insurance if you need that. But it is another layer of liability protection. So those are the different forms of organization. I won't go into great detail here. They only gave me an hour, so move on. So we'll look at the different costs that you're allowed to deduct. And the reason I have the dog there is that this is kind of a funny story. The multi-level marketing companies in the past have basically encouraged their salespeople, when they're selling their inventory out of their home, that now their home is a business location, and they can then turn their mutt into the guard dog to guard the inventory. And that makes, of course, the dog food is deductible then, and the vet bills would be deductible, that type of thing. And the IRS took that to court in those situations, and of course the IRS won. Not to mention that a guard dog couldn't be a deductible item, but it's not the family pet. That doesn't quite cut it. So that's always a fun way to start this segment. For an expense to be deductible, it has to meet 3 criteria. The first criteria is that it must be ordinary. And what that means is that it's something that you would typically find in that type of a business endeavor. So let's say for tree farming activity, you would expect to find a chainsaw. Okay, that would be something you'd ordinarily expect to find in a tree farming activity. You would also expect to find safety things like cutting chaps and face and head protection, hearing protection, that type of thing. But you wouldn't expect to find, say, like a mink cutting jacket. Okay, if you were a model, you know, a mink coat would be a ordinary expense, but not if you're a tree farmer. And so that's when, you know, somebody calls and says, well, what can I deduct? You know, there isn't a specific list of items that you're allowed to deduct. It depends on what's going to be, in this case, ordinary in that trade or business. It also needs to be what they call necessary, and that's kind of an unfortunate choice of words because it doesn't really have to be something that you absolutely positively have to have in order to conduct that business activity. It just has to be something that's going to be useful, okay, or that you think is going to be useful, and that will meet the necessary criteria. And then it must be reasonable. Okay, you wouldn't go out and buy a $500,000 processor if you've got a 40-acre parcel. Okay, that wouldn't be reasonable. Of course, you'd also have problems meeting the profit motive requirement if you did something like that. So those three requirements to make an expense deductible. And I've got some examples down here, as you can see. It's not a full list by any stretch of the imagination. It's just an example. Now, there's two different things, two different ways we can handle expenses. And depending on what kind of expense it is, we can either deduct it outright, currently deductible, or we have to capitalize it. And the items I have kind of highlighted in red here are the items that would be currently deductible. Those are things that we can deduct entirely in the year that they're incurred. The other items there would be capital items, which in theory then they will benefit you over more than 1 year. And so since they're going to benefit you for more than 1 year, then you have to recover their costs over more than 1 year as well. So things like equipment, fences, bridges, your timber basis that we'll be talking about. Now there are some exceptions here, like for equipment, that you may be saying, well, we can Section 179 that one. And you're exactly right. We'll be talking about that. But the general rule is that those have to be recovered over a period of time, but then they have those exceptions in there. We can recover our capital costs in one of three ways. We can either deplete it, and that's what we're going to be doing with standing timber, so we'll be talking about that. We can depreciate that. Those are generally with your assets, your equipment, your buildings, that type of thing. And that's an annual deduction over a period of time. And then we can amortize, and that we do with a depletable asset, and reforestation falls into that category, although we're now allowed to expense within that category now. We'll talk about that later as well. Here's some recovery periods for equipment, property that's used in forestry. So you can see your 5-year property would be timber cutting equipment, your pickup truck, computers and other peripheral stuff like printers, your calculators and your copiers. Your cell phone would be 7 years. Your office furniture, fixtures, and equipment would be 7 years. Bridges, fences, that type of thing would be 15 years. And if you have some kind of a shop building or something like that, that's a 39-year property, so that takes a long time to recover that. As I mentioned, you are allowed to Section 179 expense on certain equipment. And for 2008, you're allowed to expense up to $250,000 worth of equipment. There is a phase out if you put too much equipment into service in a particular year. That phase out begins at $800,000. These numbers don't normally impact small woodland owners. We don't normally get up to that height. There are going to be some assets that you may use that may only be partially used for business. In that case, then you have to make adjustments to the depreciation for that personal use, as well as adjustments to operating expenses. So for instance, a chainsaw, if you use it 60% for business, you can only take 60% of the allowable depreciation, and you can only take 60% of the operating expenses. But it sometimes gets a little bit confusing as to what constitutes personal use. And again, using the chainsaw, since there's no hour meter or odometer or something on a chainsaw, you basically have to prorate that based on time. But let's say you're doing a timber stand improvement job on your property. And basically what the timber stand improvement calls for is, say, to thin out the trees, pre-commercial thinning. So you need to drop those trees. So dropping those trees then would constitute a business use. Okay, but cutting them up into 16-inch lengths and carting them to your wood pile to use in heating your house would be a personal use. Okay, if you are cutting them into 16-inch lengths and you're selling that firewood, that again would be a business use. So you have to kind of watch those things there.
And Gary, that kind of leads into a question that we have. Are you referring to expenses deductible for businesses or for hobbyists as well?
For hobby, investment, or business. Okay, it's just that, and you're allowed to deduct depreciation even if you're treating it as a hobby, but again, only to the extent that you have hobby income. As an investment, you'd be able to take the depreciation and it would go in that miscellaneous itemized category on Schedule A. If you're a business, then it would go on the business schedule itself. Okay. All right, let's take a look at selling timber and how that's taxed. Mostly, the proceeds from the sale of timber is going to be subject to a capital gains tax, which is a good thing because it's not being subject then to the tax at your ordinary tax rate. So if you look at sales after January 1st, 2008, if you're in the higher tax brackets, your maximum capital gains rate is going to be 15% versus 25% or higher. If you're in the lower tax brackets, the 10 or 15% tax bracket, then your maximum capital gains rate is going to be 0. And very seldom does a tax rate drop quite that low, and it is not supposed to stay there. December 31, 2010 is supposed to be the end there, but we'll see what happens. You would then, if you're treating the property as a hobby or as an investment, you would report the timber sale on Schedule D. And there's two parts here. You can see Part 1 is short-term capital gains, and the Part 2 is long-term capital gains. If you've held the property for a year and a day, then it qualifies for the long-term capital gain provisions, which gives you those lower tax rates. Okay, and that would go in Part 2. If it's been held for less than that, then it would go in Part 1. It would be a short-term capital gain, and it would be taxed at your normal tax rate. If you're a business activity, you would start with the Schedule 4797 and report the sale there. It will flow through the Schedule D and then to the front page of your 1040 if you're a Schedule C or Schedule F, or it will go if you're a corporation, it'll go to the front page of the 1120, 1120S. There are three ways that timber can be sold. The lump sum method, which basically, you mark the timber or mark where the timber is supposed to be coming from, and you kind of determine how much volume is going to be coming out, and the buyer then pays you a fixed total amount based on the estimated volume. And he pays you that in advance or as he goes, but it's based on a fixed total amount that was agreed upon in advance. And then there's a pay-as-cut method where, in essence, they bring the timber out and it's going to be scaled on the landing or at the mill, and you're going to be paid based on how much the mill scale comes out. Both of those qualify for capital gain treatment. You don't have to worry about which way you set that up. They will both qualify. The third way is if you cut it by yourself. Let's say you've got a chainsaw and a tractor or a skidder, and you cut them and sell them roadside, or you have a truck and you deliver it to the mill, or you have your own sawmill and you further process it and sell it at some stage down the line there. That is self-employment income, does not qualify for capital gain taxes. Now there is one thing that you can do in that particular case, since that would put you at a little bit of a disadvantage in relation to other folks who may sell it to a logger. is that you can make what we call a 631A election to treat the cutting as a sale. And by doing that, then you can split the revenue from the timber sale into two different baskets. The first basket is the difference between the fair market value of the timber as it stood in the woods on January 1 of the year you harvested the timber and your basis in that timber. And that difference then will be the capital gain income. And then the other basket is the difference between the total revenue you received and that fair market value you used in the first step. And that's going to be the income that you received as a result of your labor and your processing. And that's going to be self-employment income. So there is, even if you do cut it yourself, the opportunity to still get the capital gains treatment. And that's all I'll say about that at this point. It gets a little bit more involved, but just so you know that that's available. Excuse me. When you do sell timber, you are allowed to deduct what we call basis against that timber. My favorite example is, say, like using a share of stock as an example. When you go out and you buy a share of stock, say you buy it and you pay $20 for that share of stock, and you sell it for $25, you're only being taxed on the difference between the sale price and your cost, so that $5. You're not being taxed on the full $25. And the same exact thing applies to timber. It's just not quite as easy to figure out what your basis is. So we're going to talk about that. First, we'll start with a definition of what actually basis, from a tax perspective, how we define that. And it's simply your investment in the property for tax purposes. Okay, so that's all that basis is. And so what is your basis? And the answer there is it depends on how you acquired the property. Okay, if you purchase the property, your basis is going to be what you paid for it. Okay, just like that example that we had with the share of the stock. And that's probably the most common way that property is received or acquired. But there are other ways. You can inherit the property, which is a nice way to receive it, because then your basis is going to be the fair market value generally on the date of the decedent's death, unless the executor of the estate made some other election there. Okay, so that's nice. You know, if you sell it the day after you inherit it, you basically don't have any gain or loss because your basis is the fair market value. Another way you can receive property is as a gift. And generally, if you receive property as a gift, your basis is going to be the same as the basis was of the person who gave it to you. So a good way to remember that is that they gifted not only the property, but they gifted the basis as well. Okay, and that can be sometimes difficult to figure out what their basis was, because they don't normally give you that information when they give you the property, or they may not even know that information. So that can sometimes get a little bit complicated. There are two different ways that we can do an allocation of basis because, in essence, when we purchase property, I'm just going to be talking about purchase at this point. When we purchase property, we generally buy the property for one fixed amount. Okay, we don't say, well, I'll give you X number of dollars for the land and Y number of dollars for the buildings and Z number of dollars for the timber. We're just giving them an X number of dollars for the property. And so the IRS does allow us to make an allocation of our purchase price to the various attributes in order to treat it from a tax standpoint, because land is treated differently from timber, and timber is treated differently from improvements. Okay, land itself cannot be depreciated, cannot be depleted, cannot be amortized. The only time you can recover that basis is if you sell the land. Timber can be depleted, and improvements could possibly be depreciated if you're renting them out or using them from a business standpoint. So there are two ways to make that allocation. The first way is to allocate based on relative fair market values. And the second way is what we call the residual method. For the first way, to allocate based on fair market values, we've got to look at what the fair market values were on the date that you acquired the property. So you're going to need to know the timber volume and what its fair market value was on the date you acquired it. You're also going to need to know what the land fair market value was on that date as well. excuse me, and the improvements. Okay, and then what we do is we add up all those fair market values and we get a total fair market value number. And then what we do to say we're going to allocate to the timber, we're going to take the fair market value of the timber at the time of purchase, so ATP's at the time of purchase, FMV's fair market value, and we're going to divide it by the total fair market value that we added all three together at the time of purchase. So that gives us a relative fair market value of timber to the total, multiply that by the purchase price, and that gives us the amount of the purchase price that we'll be able to allocate then to the timber. And we do the same thing with the land just by replacing the numerator with the fair market value of the land at the time of purchase. Okay, and so we could allocate out the land, timber, and improvements. An easy example here, landowner purchases a piece of property for $60,000, and they had an appraisal done. They found that the land was worth $50,000 and that the timber was worth $25,000 as of the date of purchase. So we total those together, we come up with a total of $75,000. Now the first thing you say here is that, well, there must be something wrong because they only paid $60,000 for it and its value is $75,000 when we add that together. And that's really not a problem. All that means is that you got a good deal, right? And it's all going to come out in the wash as you will see. To do our allocations then, the land's fair market value was $50,000. We put that over the total fair market value of $75,000. So the land fair market value represented 66.67% of the total. So we multiply that times the $60,000 purchase price, and we come up with $40,000. That's how much we can allocate to the land. With the timber, its fair market value was $25,000. The total fair market value being $75,000, that represents 1/3 of the total, times $60,000. We come up then with $20,000 of basis we can allocate to the timber. So if we add the $40,000 we allocated to the land with the $20,000 we allocate to the timber, we come up with the $60,000 purchase price. Okay, so that's a simple example, but it shows you how that works. Now the residual method, on the other hand, is a little bit easier, but we don't generally end up with as good a deduction as we do using the other allocation method. And the residual method, basically we're subtracting from our purchase price the fair market value of the land and the improvements. And what's left over then, we allocate to the land. So in this case, if the land fair market value was $50,000 and we paid $60,000 for it, the residual is $10,000. And so as you see, using the allocation method on the fair market values, we come up with a higher timber basis than we did with the residual method, and that will always work that way if the fair market values, the total fair market values, exceed the cost. Okay. So let's take a look then how we use our basis. If the landowner in our example sold all the timber on their property for $30,000, and our basis then is the $20,000 using the one allocation method, then we just are allowed to subtract that from the total of the 30. We're taxed on the $10,000 gain then. If you use the residual allocation method, your basis would be $10,000. You'd be taxed on a $20,000 gain. If you sold half of the timber, you're only allowed to use half of the basis. The other half will stay in a timber account with the timber that's still standing. And so let's say you sold half the timber for $30,000. In this particular example here, you could use half of that $20,000 basis of $10,000, so then you would have a $5,000 gain. You sold half. The other $10,000 basis, as I mentioned, you still have. It just hasn't been used yet. Later on down the line, when you have another timber sale, you'll be able to use more of that. There are some issues surrounding the allocation and use of basis because it's not going to be beneficial for everyone to go out and determine what their timber basis is, because there is kind of a cost benefit here. If a person's owned the property for a long period of time, for instance, it may not be quite as beneficial. And I think I've got that slide here. We'll just move on here. Yep. the reason it's not beneficial if you've held it for a long period of time is that over time things change. Number one, the timber grows over time. So if you brought the property back in the 1950s, the timber was much smaller then. It may have had very little value. Okay, and so if it had very little value at that time, there wouldn't be much you'd be able to allocate to the timber. Also, the prices have changed over a period of time. I remember back in the early 80s, you couldn't give aspen away, and so now if you have aspen property that you bought then, there may not have been much value there to an allocation. And the third reason is the changing value of a dollar. From a tax standpoint, the dollar that you spent in 1950 is the exact same dollar that you have as basis today. Okay? It's not adjusted in any way, shape, or form. And so if you bought a piece of property for $20 an acre, there isn't going to be much to allocate. If you receive the property as a gift from someone who's owned it for a long period of time, remember, you not only receive the property as a gift, but you receive their basis as a gift as well. And if they've owned it for a long period of time for the same three reasons, it may not be beneficial to allocate basis. Finally, if you are going to be selling the property soon after you're selling the timber, you can just take all of the basis when you sell the property, and then not go through the cost of doing it now. We do have to consider growth when we determine the amount of basis that's allowed on a sale, and that kind of complicates things a little bit. It's going to, in essence, factor in the calculation of what we call our depletion unit. Now, I simplified on the example when we had the timber sale. I said, well, if you sold half the timber, you could take half of your basis, which is basically how it works out. But the way we're supposed to calculate it is we divide our total timber basis by the amount of timber we have available for sale, come up with, say, $1 per cord, or $1 per thousand, or $1 per unit, or $1 per whatever unit of measurement you're using. And that's our depletion unit. We then multiply that by the number of units that were sold. So we have to include growth in that, and that tends to reduce our depletion unit over time. So that's one curiosity that I like to share, is that our tax code basically makes it so that we cannot fully recover our basis unless at some point in time we clear cut our property. So I guess you could say that our tax code encourages clear cutting. Timber accounts. Okay, I mentioned before that if you didn't use all your basis, if you didn't have your clear cut, you retained some of that basis and it stayed in your timber account. Now, we are required to have up to three timber accounts if we meet all these categories: a merchantable timber account, the young growth account, or if you have a plantation. If you just have the merchantable timber, you just have one timber account. If you don't have much young growth to be worried about, then I wouldn't spend much time on that. But within the merchantable timber account or the plantation account, you can have many other sub-accounts. You can set up as many sub-accounts as you want, based on just about any criteria that you want. And again, I won't go into detail on that, but there are some advantages or disadvantages of doing one or the other. And so depending on your personal circumstances, you may want to have more than one timber account. Okay, let's take a look at tree planting. There are some benefits, some tax benefits of tree planting. And this is covered under Code Section 194, if anybody's interested in pulling out their Internal Revenue Code. Allows basically the expensing of up to $10,000 of qualifying expenditures. If you're married filing separate, each one of you can just do up to $5,000. If it's a trust, even if it's a grantor type trust, you're not allowed to expense it all. You have to do the amortization. You can also elect, instead of the $10,000 expensing, to amortize over the 84 months, and you are required to amortize over the 84 months any expenditures that exceed the $10,000. Now, this is on a per-year basis. Okay, $10,000 in 2008, $10,000 in 2009, $10,000 in 2010, et cetera, et cetera. Okay, and again, this applies to everyone, hobby, investment, or business. The qualifications, the property must be that you're reforesting must be at least 1 acre in size. It must be located in the United States and must be held for use in producing commercial timber products. Okay, so that's important with this as well. Now note here, for those of you who treat your timber activity as a hobby, there's nothing in the qualifications that indicate that it has to be for profit. Okay, that just that you're producing commercial timber products. The qualifying expenditures, we have the cost of the trees, obviously, site preparation, the cost of the planting, any mileage that you have in relation to that, any labor that you have to pay to have the trees planted. If you're planting it yourself, depreciation on equipment that you're using in the planting. Really, any cost that meets those criteria that we talked about earlier, ordinary, necessary, and reasonable, okay, will qualify as a qualifying expenditure. You may also have qualifying expenditures in years after you planted the trees. Let's say you planted the trees in 2008, and in the spring of 2009, you see that the grass is taking over and is threatening the survival of your trees. So you have to go back in and apply some herbicides to basically keep the trees from being overtaken. That would also qualify. If you do have to amortize your expenses, or choose to amortize your expenses, it is over a 7-year period. However, they do require a half-year convention in the first year. So we get 1/14 in that first year, and then we'd have 1/7 in the 2nd through 7th years, and then we would deduct the remaining 1/14 in the 8th year. Okay, now how do you make the election? Okay, the code does give the responsibility to the IRS to establish regulations on how to elect the expensing. And unfortunately, they haven't yet issued those regulations. The timber tax website, which is no longer there, did indicate that to make the election, you would just report the allowable amount. But I don't quite think that that's a really safe way to handle that. And I would attach a statement that refers to the code section that I have listed there. And the reason I choose to do it this way is because the IRS has determined how we make the election for amortization. And to do that, we have to attach the election to the return, which indicates the code section and lists the amounts, dates, nature of the expenditures, the type of timber being grown, and the purpose for which each type of timber is being grown. And if you've been paying attention, you know what that purpose has to be, right? For the commercial production of timber products. Okay, and that has to be attached to the return. And since the IRS requires this to make the amortization election, I can't imagine that they will require anything less when they come out with the regulations for the expensing. And of course, the way that works is when the IRS finally does come out with the regulations, we were supposed to know how to have done that all along. And it's the way that always works. So I'm always conservative there. Make sure we cover all of our bases. Where do you report this? Well, this is kind of an interesting thing, because if you're treating it as an investment or as a hobby, remember all your expenses end up on Schedule A, your itemized deduction schedule. Well, not this. Okay, what you're allowed to do here is to treat this as an adjustment to income on your Form 1040. Okay, and I have an example here. You see a Form 1040. The adjustments to income section is right down here at the bottom. Okay, and I'm going to kind of focus in on that on this next slide. And if you look through all these lines, you won't see anything about reforestation. But what you do is on line 36 here, where we're adding all the lines ahead, we put RFST, stands for reforestation, and the amount. And then we include it in the total over on the right-hand side. Okay, so you don't have to itemize to be able to take this deduction. If you're treating your business activity as a business, then the expense will go right on the business form. So whether it's a Schedule C or Schedule F, it'll go on that form. If it's a 1065 for a partnership, it'll go on the 1065. If it's an 1120S, it'll go on the 1120S. Okay, there are some recapture provisions. Obviously there's no free lunch. If the trees are disposed of within 10 years, any of those amortization or expense deductions claimed are subject to recapture as ordinary income. Okay, which makes sense. They allowed you to deduct that, and then you don't keep it. Well, then you need to give it back. It doesn't apply if you dispose of the property by gift. Okay, so you won't have to recapture then. Or if you pass away, they give you a little bit of a break there as well. Okay, you don't have to recapture it. If you transfer it through a like-kind exchange, where say you're giving up, real estate for other real estate, or an involuntary conversion, that would be a situation where you had, say, like your neighbor was debris burning and it got out of hand, okay, or a tornado came through, or the state decided to put a highway through your planting. Okay, none of those would recapture then. Or some kind of a tax-free transfer, like in exchange for stock, if you're transferring it to a corporation. Okay, they wouldn't apply then as either. The amount of the recapture is going to be then the lesser of the amount of the expense and amortization claimed or the gain realized on the disposition. So if you sell it to Walmart so they can put it in a parking lot, you'll have to recapture up to the amount of the expense or amortization you claimed if your gain on that disposition was greater. And it's about 1 o'clock, so here we are. We've got a little bit of time for questions. And so if you've got a few questions, why don't you go ahead and type those in, and we'll hang loose here for a second.
Thanks, Gary. We've got a little bit of time. If you have a few more slides that you want to get through, or no? I'm good? Okay, great. I've got, while you're getting ready to, I'll leave Gary's contact information up if you want to write it down. He's got an email address and a phone number if you want to contact him. I've got some questions that I also like to pose to you while you're typing in your questions for Gary, so I might just, let me leave this up just a few more seconds, and we can come back to it too. If you wouldn't mind filling out this poll, and feel free to type in your questions and send them our way. Your head might be swimming with all the taxation issues that Gary has raised, but if you have some specific ones, and if we don't get to your question during the session, we will be posting them on the web, all the questions that we get on the website, so that you can go and read them afterwards. But please fill out the poll. Like I said, if you have questions, type them into the questions sent part of your questions pod and hit send to me. Looks like just about everybody has filled out the poll. Let me ask you another question. I think you did such a great job, Gary. People don't have any questions. They all understand it very well.
That's not good. Then they won't call me.
Now, when we were scheduling the session with you, Gary, you mentioned that this tends to be a busy time of year for you as an accountant, and especially for woodland owners. Have you been getting a lot of? Do you work a lot with woodland owners on these kind of tax issues?
Yeah, it's a big part of my business. I work with landowners basically throughout the United States on this, so it is a big part of my business.
Okay. Can people still contact you now to do for like 2008 taxes?
Sure. If there's any field work that needs to be done at this point, I obviously can't come out and help with that. But yeah, we can. I'm certainly available.
Okay. I got another poll question for you.
Are you running the poll?
Yeah, go ahead, Chris.
Bill? I was just going to mention while people are answering that next poll question, there was a question about what the last class is going to be, and based on the voting from the first 2 weeks of the classes, the last class will be the insects and diseases.
Thanks, Chris. Well, I got a question for you, Gary. Are timber selling taxpayers audited more often than regular taxpayers?
Make sure I'm on here. Yeah. If they treat it as a business activity where they don't have a fairly steady stream of income, the answer would be yes. They probably are. You know, there are different things in a tax return that increase the audit score, and obviously one of them is being self-employed. Okay, so it's hard to get around that if you are self-employed. But another one is that the self-employment business basically generates losses year after year after year. And so if we have a small timber owner, you know, who has a harvest maybe every 20 or 30 years, then their audit score keeps going up. And so yeah, they do tend to be audited for that particular reason, you know, fairly often. Now, fairly often isn't a tremendous amount. I mean, we're only looking at, I think, the overall audit rate last year for individuals was somewhere around 1.5%. So we're not talking a huge number there. And that's why I kind of went through, you know, the ways that you can show that you do have a profit motive. Because if you do go that way, I strongly recommend that you be prepared for the audit. And you know, there's no reason why you can't survive it if you do honestly have a profit motive. It's just that you need to think about that, and you do need to you know, do your homework and be ready for it.
Okay, Gary, I got another question for you. This one states, if holding a timber lot for 10 years is capital gains the easiest way to claim income with no other activities to expense?
Yeah, basically, well, if you're having a timber sale, you've held it for more than a year and a day, so it does qualify for the long-term capital gain provisions, which then gives you that lower tax rate. You know, regardless of whether you sell it, holding it as an investment or as a hobby or as a business, you would qualify for the capital gains rates unless you're a C corporation. They don't generally get the capital gain provisions. One exception this year, but yeah, generally that would qualify regardless of how you hold it, regardless of how you're treating your expenses.
Okay, Gary, I think you might have answered this question already, but I'll ask it again. This question is, we live in Illinois, but our timber acres are in Wisconsin. Are you able to do our taxes being out of state?
Oh, you betcha. You're going to have 3 returns to do, basically. You've got your federal return to do. Wisconsin's going to want their cut on the timber sale income because the property is located in Wisconsin. And then for Illinois, you will get a credit for taxes paid to other states for that income that was taxed to Wisconsin. And yes, I'm able to do taxes from any state and electronic file for any state. And so yes, to answer that question quickly.
Okay, so there's no other questions up there. Here's a chance to type one in for Gary. We'll wait a couple more minutes, otherwise we'll be ending the session soon. Again, hopefully everybody can see Gary's contact information is up there. If you want to reach him, you can send an email or give him a call. I'm pretty sure he'll be around after we get done with the session, so if you want to contact him right afterwards, you might have other things going on, but he'll be available to answer your questions if you want to talk to him in person. All right, well, no other questions are coming up, so I appreciate everybody attending the session today. Next week, I believe, is on the timber harvesting, our introduction to timber harvesting, and and then, as Chris said, the last session will be on forest health issues, insects and diseases. So, all right, I appreciate everybody's time, and we'll see you next week.